Hey everyone, welcome back to the Hashrate Happy Hour Podcast, where this week I had the pleasure of sitting down with Jamie McAvity, the CEO and founder of Cormint. This conversation is an absolute treasure trove of information when it comes to wind power and Bitcoin mining. We go deep into the history of wind farms and renewable energy in ERCOT, the differences between being collocated versus behind the meter at a wind farm, and Jamie shares the exciting new investment vehicle that Cormint is offering as it is expanding its operations. This is truly one of those episodes where you're going to want to have a notebook handy to take notes, especially if you've ever wanted to know more about how Bitcoin mining is done at a wind farm. This show is managed by Foreman. Get it? See what I did there? Foreman helps you manage your entire Bitcoin mining facility all from one simple dashboard. That's demand response and power controls to miner and facility mapping and business intelligence, all on one clean dashboard. Guys, this software is absolutely incredible, and it's what I personally use to manage the small miner fleet that I have online. And I think that's what I love about this the most, is that it even lets the small miners, the plebs, have the ability to manage their computers like the pros. It's always also really impressive when I walk into these large mining facilities for my day job, and I look around in their control room and I see a 70-inch plus flat screen TV with their entire mining operation completely mapped out in Foreman, exactly how you would see it out on the floor. This is a truly invaluable tool for miner management, as well as being able to manage and automate your curtailment strategy. So please go check them out online today at foreman.mn. That's Foreman.mn. And no, that's not because they're huge fans and supporters of the state of Minnesota. That's just their website domain. It's foreman.mn. Today's podcast is brought to you by our sponsor, the Texas Blockchain Council, a Bitcoin-first nonprofit industry organization working to make Texas the jurisdiction of choice for Bitcoin mining and blockchain innovation. They will be hosting North America's premier policy conference for Bitcoin and the digital asset ecosystem on November 15th through 17th in Fort Worth, Texas. For more information, please visit their website at texasblockchaincouncil.org. Hey everybody, welcome back to the show. Like I said in the introduction, I'm here with Jamie McAvity at Cormint. Jamie, welcome to the show.
Great to be here. Thanks for having me.
Yeah, I'm excited to get into this conversation. You guys have a fairly unique position in Texas and with your energy generation, which we're going to get into all that. So I don't want to get too far ahead of myself, but I'm really excited to dive into that and some of the unique perspective that you and Cormint have on Bitcoin mining. Where I like to always start, Jamie, is I really do like to hear about your background, my guest's background. I think it's always kind of a nice lens to put on the conversation to hear where you're coming from before Bitcoin mining, and then what was that catalyst that got you into the Bitcoin mining space, because it's a pretty niche space.
Yes. Yeah, that's found out about Bitcoin and I didn't move into it for 4 years, which was always a mistake. But I started my career on the floor of the New York Mercantile Exchange, which was what became the Chicago Mercantile Exchange following an acquisition in 2007. But I was in, if you've ever seen the movie Trading Places, I was in one of those commodity trading pits where the way that order flow is broadcast and executed is a bunch of guys sitting around shouting at each other. And I worked for a brokerage shop at first, and then I started working directly for what are known as local traders. So the way the ring works is the outside row where there are guys on the phones passing order slips to the brokers. That's all customer business. So they're, on the phone with trading shops all over the world or commodity market participants, taking orders, giving them to the brokers. And then the guys who are sort of on the inside of the ring down a few steps are the locals. And they are proprietary traders who are making markets and taking positions from all of those other market participants. And so I started there. I was in the crude oil pit, but I worked for some guys in the gasoline pit, the natural gas pit, the options that trade on those markets as well. And that was where I started my career. I eventually did become a trader myself. And by the time I became a trader, the markets were all shifting away from Open Outcry into the CME Globex platform, which was an electronic trading system. And so the way that I carved out my business there, which I built and ran for about 10 years, was the markets were shifting from Open Outcry to electronic trading, which meant the markets were open 23 hours and 15 minutes per day. They only closed from 5:15 to 6:00 p.m. Eastern. And
oh wow,
there were lots of periods of illiquidity, especially in the overnight session during geopolitical events like wars, financial crisis, the Eurozone banking crisis. Those were typically the times that were the most lucrative for my career, just because there's illiquidity, there's news happening all the time. So it was very much a 24/7 type of job. And there was less opportunity for that type of job, a market maker, when the markets transitioned away from Open Outcry to electronic trading, because algorithmic market makers replaced human market makers. Mm-hmm. But I was able to have a pretty good business for those 10 years, mainly because there was a lot of market volatility during that time. But 23-hour and 15-minute per day market hours are not a recipe for a healthy way of living. Just
I can imagine not.
Yeah, I had a position on, huge positions on that were mostly hedged, where I was long certain months and short other months in the future, the futures curve going all the way out. And basically you're always looking for opportunities to take your position off. Typically the way it works with a market maker is you get paid a spread on the bid ask when you put a position on. It's oftentimes the worst positions in the market, because that's the one that everybody sort of wants to get rid of. So they dump it off to you, and then you just have to pay attention all day to try and take it off. So after running that business for about 10 years, I left it behind, and I went and worked in a technology startup in Washington State that was in 2013. And the same time I made the decision to stop trading was right around the time that I bought my first Bitcoins, and I did not make the decision to move into Bitcoin. I went and worked on a technology startup company with two of my best pals out in Washington State. But obviously, looking back in time, I wish I'd taken every penny that I had and bought Bitcoin and gone all in on Bitcoin, but I didn't. It was still a valuable experience building a different type of company. But in the 2017 bull market, my 1% allocation to Bitcoin became 50% of my net worth. And I started attending conferences and learning about all the shit coins and trying to understand, why Bitcoin was different. The typical rite of passage of all Bitcoiners, where you get a little Bitcoin, you learn a little bit, and then you realize all of the things that you don't know. Dabbled in lots of shit coinery, and actually Cormint's first days as a company were as a GPU mining company, and our strategy was to spec mine early proof of work currencies. And we were all hardcore Bitcoiners going into it and needed to do GPU mining because our electricity costs weren't that good in the early days. And so, we were trying to mine other proof of work currencies and convert them back into Bitcoin. But ultimately, we had our kind of return to Jesus moment and said, we can't be spec mining shitcoins anymore. We don't believe in any of this. So
Sure. I am curious what, so when you started the GPU mining though, It sounds like maybe that was more of like an approach of just like some general arbitrage then, right? I mean, so you guys kind of saw, okay, we can speculatively mine for like Dogecoin, pick up a shit ton of Dogecoin, and then convert that into Bitcoin. Obviously, probably wasn't Dogecoin at the time, but
Right. Yes.
was that kind of the premise then?
Yeah, the premise was that there were some proof of work coin launches that were extremely valuable if you were running mining nodes at the launch. One of the best examples was a company called, a cryptocurrency called Ravencoin.
Oh yeah,
which was designed to be sort of an asset tokenization layer. And it had a mining algorithm called X16R, which was, it rotated between 16 different types of proof of work, and it was random. So you had no way of knowing what the next one was going to be. If you spec mine that at launch, you would have made like 5,000% ROI.
oh my God.
Because the token wasn't trading, and then it pumped when it did trade, and Bruce Fenton was involved with the project, and he was, kind of shilling it. And so we were watching that, and at the time, I think our power costs were 6 or 7 cents. So ASIC mining was not modeling out to be extremely favorable. This was throughout 2017, and we got really excited about the launch of 2 other proof of work coins that were privacy focused using the Mimblewimble technology. And they were, somewhat supported by Bitcoiners. One was called Grin and another was called Beam. They both ended up being extremely uneventful launches, but they were proof of work mineable using GPUs. And because of our electricity costs and our technical capability of building GPU mines, operating GPU mines, and setting up the node infrastructure to be able to mine proof of work coins very, very close to their launch, we positioned ourselves to be, amongst the largest GPU miners of those 2 coins when they launched.
Oh, wow.
If you look back at the charts of both Grin and Beam, they look like a lot of shitcoin charts where they start off with a very high fully diluted market cap, and then they immediately drop like a bag of bricks. That was exactly what happened. But we got into mining through buying SHA-256 ASICs, and then once we were confronted with the economic realities that our data center electricity costs were not economical enough to be competitive in that business, we pivoted to GPUs briefly and went through 2 proof of work shitcoin launches that didn't work out, and ultimately sort of made the decision to return to focusing on Bitcoin only. But
sure,
that, part of that decision was saying, hey, we have to move to where the electricity cost is very, very cheap and scalable. That's why we ended up where we are now in West Texas.
Oh yeah. Well, I can't even imagine how exciting all of that had to have been, though, to be kind of at the leading edge of, a couple of those launches. And I mean, for me, the whole GPU mining, that has always seemed way more complicated than like plugging in ASICs and logging into the IP. So I bet that was very exciting. Carter at Bits Be Trippin' is a big Raven coin miner as well. And actually, I don't think him and I chatted about that, but I remember seeing a lot of his videos around Raven coin as well. So that one was a very familiar project to me. So I'd love to, because I think this is a really nice transition then into Cormint and kind of Cormint as we see today. So maybe what was the genesis of, so we already talked about the genesis, which was the GPU side of things, but then you said you started to pay closer attention to your power cost and got more serious about that. Maybe start us in Cormint's journey from there then, and kind of where you guys are at today.
Yeah, sure. So in 2017, I met my business partners, the co-founders of my company, and at that time, they knew more about Bitcoin than I did, and they helped me understand why the block size wars were inevitably won by the small block camp, and why that was the important side to emerge victorious there. I had experience building startups and with commodities. They had experience with running miners and building data centers and electrical engineering. So we got into Bitcoin mining, I think, the same way that a lot of people do, which is somewhat naively so, where we looked at ASIC prices, we looked at Bitcoin denominated return potential of converting some of our Bitcoin holdings into ASICs, and we wanted to support a new mining company called Halong Mining, which was started by a bunch of Bitcoin OGs in response to what was perceived to be by the market kind of some not so great business practices by Bitmain. And so these OGs started Halong Mining, and they did a run of SHA-256 ASICs, and we committed to their pre-orders. We funded our purchases in Bitcoin, and then we began down the journey, like all first-time Bitcoin miners do. Of you bought machines, now you sort of got to scramble and figure out what to do. You can either enter into a hosting contract where your electricity costs are probably pretty high, or you can try and do it yourself, and then you're dealing with utilities, you're dealing with landlords, you're dealing with local governments, all kinds of ways that can go wrong. So we had these miners. We quickly realized our power cost was not going to be great to recoup our Bitcoin denominated investment. Also, this was 2018, where the price of Bitcoin dropped from $20,000 at the beginning of the year to $3,000 at the end of the year, and simultaneously, hash rate went from 5 million terahash to 60 million terahash in the same year. So, one of the worst calendar year bear markets for Bitcoin mining, I think, in the history of mining, and it culminated in a big difficulty adjustment and hash rate drop right around Thanksgiving of that year. But we were fortunate enough to be raising most of our seed capital in the third and fourth quarter of 2018, and with the existing data center contracts that we had negotiated and people who we met, and we knew that we couldn't really do ASIC mining at scale, since at our power cost, most of the ASICs on the market were already operating at break even. So we bought a whole bunch of GPUs and did the spec mining approach for the first 6 to 9 months of our existence as a corporation, before deciding, this is not for us. Doesn't appear to be financially viable, and it's not consistent with our view on where the industry is going. So we made the tough decision to just begin the search anew for scalable jurisdiction with very low cost power, and we zeroed in on West Texas, and it took us a full 2 years to actually get an interconnection and a good site that we could scale into a real business. And that site was actually, it was a stroke of luck that we found it anyways. It was a decommissioned wind farm. Then we actually spoke to the owner of the wind farm while it was still an operating wind farm, and they said, we'd like you to come and co-locate and come behind the meter and build your Bitcoin mine here. And we looked at the numbers and concluded that it wasn't going to meet our criteria. We still had a few other sites that we were looking at. And about 4 months later, they came and said, okay, well, we're going to decommission the turbines altogether, and why don't you just take over the transmission infrastructure? And so that was what we ended up doing.
Jamie, can I just interrupt there and actually ask you, what was driving that wind asset to decommission? Like what was pushing the ownership group of that to just fully decommission it?
Yo, I'll send you some graphics that you can post in the show notes. But basically, in the there's two developments that occurred in the state of Texas in the mid 2000s. One was the development of a system of transmission lines called the CREZ lines. CREZ stands for Competitive Renewable Energy Zones. And the other event that occurred was the first issuance, or first, I guess, passing of the production tax credit for renewable energy, where the federal government actually gives you a tax credit to generate renewable energy. So the competitive renewable energy zone lines connected parts of remote West Texas to Eastern Texas, where most of the industrial activity and residential areas are. And so when they build these transmission lines, they effectively opened up tons of very cheap land with great wind and great solar generating capabilities to development. And what happened after they built those transmission lines and people became aware of these tax credits was the biggest wind energy development boom that has ever occurred in the history of the species, as far as I know, where you went from 0 megawatts of generation capacity, or very, very little, to 35,000 megawatts, so 35 gigawatts of wind energy that was built. The CREZ lines and the renewable energy production tax credits. Mm-hmm. Those two developments, I think the production tax credits were in the late 90s and the CREZ was in the mid 2000s, early 2000s. That sparked a development boom of 35 gigawatts of wind power.
Yeah, it was like a true build it and they will come moment, from what I remember, reading about CREZ.
For sure, yeah, and the first projects that got up and running did great because there was, the state was growing, demand for power was growing, the transmission was there, and I think before a lot of that wind got installed, the financial models for it looked fantastic, but it got to the point where the amount of wind that was built exceeded the transmission line capacity to actually export the power. So the CREZ lines have a little under 20 gigawatts of capacity for total power, and there's 35 gigawatts of wind. So what happens when that transmission line capacity gets saturated is the power cannot go out, so it just reduces the price. So you'll see power go to $0 very quickly, and then because you're still collecting a tax credit for generating the renewable energy, those wind farms will actually generate up to negative $26 per megawatt hour, which is 2.6 cents a kilowatt hour right now. And historically, the tax credits have gone up in value, so that I guess call it the floor of the negative price that they will generate up to has moved and become more negative as time has gone on. But the tax credits themselves last for 10 years and then they expire. So if you're a wind farm that's 11 years old, your competition is still profitable, generating negative priced power, and you're not. And so that's what happened to the wind farm that we bought. They were in year 12.
Got it. Huh. And so they lost the credits, and then did they just not have an off-taker for that energy then?
No, I mean, prior to Bitcoin mining, there was really not a suitable co-location off-taker for a lot of these renewable projects, because the intermittency creates,
because they're in the middle of nowhere, right?
There's not a lot of flexible loads who can just power down, and then that still is consistent with their business plan being viable. But Bitcoin mining can do that. It's a very flexible load. It's a economically perfect consumer of electricity. So it's just about consuming when the output, the Bitcoin denominated output, exceeds the electricity cost.
Okay. Yeah. So interesting. And so, I mean, at that type of, being co-located, you do also still have to have some grid tied power too, correct? Because I know that the capacity for the load factor on wind is 40%. I think kind of is like the average in even West Texas, right?
That's about right. Yeah. So you have the nameplate installation of the wind farm. So the wind farm that decommissioned, which is now where our Bitcoin mine is, their nameplate installation amount was 150 megawatts.
Mm-hmm.
And what the kind of output curve, what it looks like is 5 to 10% of the year there's some amount of load on or some amount of generation occurring, but it's very minimal, and it sort of ramps up where if you wanted to get around the clock power from the wind farm, you'd be looking at maybe 10 megawatts for a 150 megawatt wind farm. You'd have around the clock power 10 megawatts. So I guess that's 1/15 of the nameplate capacity. Yeah. That'd be what you could get around the clock. And then as you sort of move up the curve, that's what gets you to that capacity factor number, which is between 30 and 40% of the nameplate installation capacity of the wind farm. That is what it is capable of outputting. And so it's sort of a weird way of thinking about it. There are some days and some periods of the day, usually in the nighttime, when 150 megawatt nameplate wind farm is generating 150 megawatts, but it's when wind speeds are 35 miles an hour, and usually it's in the middle of the night. Most of the time when wind speeds are lower, below 10 miles an hour, they're not generating at all. And wind power is it's an inductive form of power, which, if you look at the way that a wind turbine works, it actually needs a little bit of power to kickstart the generation, and then it uses the momentum to kind of keep going.
Sure. Oh, it's fascinating. And I think you guys are also currently located at an active wind farm in addition to the decommissioned one, correct?
That's correct. Yeah. So there's the wind farm that we took over was the first phase of a wind farm that was built by BP. The second phase, neither phase was owned by BP after the first 10 years, but the first phase was sold to a private equity company that we did our deal with. The second phase, which is 130 megawatts, was taken over by a different company. And so they're still actively generating, and we share a transmission line with them. So there's a private transmission line that connects to the grid. One part of the line connects to our substation where the Bitcoin mine is. Another part of the line connects to their substation where the wind farm is. And then the two lines kind of meet in the middle and connect to the grid together. But they're separately metered, totally unaffiliated projects.
And now a quick word from our sponsor. This show is powered by Giga Energy. Giga Energy is a vertically integrated Bitcoin mining company that manufactures all of the electrical infrastructure needed to start mining Bitcoin. Whether that's medium voltage switchgear, PDUs, or power cables for your miners, the team at Giga Energy has you covered. Reach out to their sales team today for all of your electrical infrastructure needs at sales@gigaenergy.com. Use the word hashrate for the subject of the email, and you'll get 5% off your order. All right, now back to the show.
Oh, okay. I guess, Jamie, I'd love for you to maybe dive into like how you guys view both projects, and maybe like what, and we've already kind of talked about some of the benefit, but maybe just go a little deeper on like the benefit for Bitcoin mining at the decommissioned site, and then the benefit of Bitcoin mining at your other site that's not decommissioned. Maybe just kind of talk about those, because I think there's it's probably vastly different approaches and where the benefits of Bitcoin is coming in.
For sure, yeah. Well, it's funny, coming out of the summer of 2023, which is, highlights a growing problem in ERCOT. Well, it's not necessarily a problem. There were no blackouts this summer or anything like that, but the penetration of renewable energy into ERCOT is now making extreme power price volatility occur. And if you compare the consumption profile of a Bitcoin miner in, say, West Texas with a Bitcoin miner who is located next to a hydro plant or located behind the meter of a nuclear reactor, it's totally different. And those Bitcoin mining operations are pretty steady. Just kind of run them, keep the uptime going as much as possible via maintaining your fleet and taking good care of your cooling and miner maintenance and all that. Whereas a West Texas based miner is definitely leaving some money on the table if they're not actively curtailing their Bitcoin mining load at least some percentage of the year. Our uptime through the first half of the year was about 90%, and most hosting contracts start at 95% uptime requirement, and there's negotiation if you deviate away from that number. So the mining business model in West Texas is very different from the way that mining has conventionally been done, and the reason why it works is because you have a large penetration of intermittent renewables, and you have negative pricing 15% of the year. And the other side of the spectrum of negative pricing is you have pricing that's $5,000 a megawatt hour, which is $5
right.
a kilowatt hour. You have this massive volatility band in which prices can float, and they do float. Pricing intervals in ERCOT are every 5 minutes. So, we'll see price spikes occur very suddenly. And then we've got some great power optimization software that can bring down the entire mine very quickly. And that's, sort of our business model is to just only mine when it's profitable. The flip side of economic curtailment is if you're being settled in the real-time market, when you curtail, you just don't mine for that interval and you avoid high prices. If you are long a power hedge and you've pre-purchased lots of power or a power contract around the clock from another counterparty in the electricity market, when you curtail your mine in response to high prices, you actually collect the difference between the price of your power purchase agreement and wherever the real-time market price settles for that interval. So Riot just released their August performance, and they made $31 million in power optimization.
Staggering amount of money from power optimization. Yeah.
They have 10 and change exahash, which is about 400 megawatts of power. And so when you have a month like August, where the average price of electricity around the clock in ERCOT during August was 20 cents a kilowatt hour, $200 a megawatt hour.
Whoa.
And you compare that with the average for the year, which was 4 cents a kilowatt hour. So there were a lot of intervals where prices were below 4 cents, in the overnight and during the early morning, say from 9 o'clock to noon, when the solar was generating and the temperature wasn't that high, prices were still 3 cents a kilowatt hour, 4 cents a kilowatt hour. But it was really when the solar ramped off, which is 7, 8 o'clock, and the wind generation hadn't picked up yet, that you saw an average price over $1,000 a megawatt hour during the month of August. And so
Jeez.
if you had a power hedge locked in and you were able to curtail your Bitcoin mining load very rapidly in response to those prices, you collected the difference. So, you made over $900 a megawatt hour on average for those hours when the solar ramped off and the wind hadn't kicked up yet.
Yeah. Actually, do you mind if I ask, this is kind of a naive question, or just, I don't know a whole lot about like that actual implementation. So is there a way that the markets can monitor that you're actually dropping the load to be able to sell it back into the market? I mean, I would imagine there are checks and balances to make sure that, Riot isn't running 100 megawatts, but trying to sell 100 megawatts onto the market.
Right. Yeah. So the way it works basically is a typical power hedge is what's known as a take or pay hedge, which means you have a counterparty in your power contract, and it's actually a physical contract. So that counterparty will go into the ERCOT system and schedule a physical trade with you where the electricity that ends up being consumed at your substation, at your meter. So in Riot's case, we'll just talk about the Rockdale facility, the former Alcoa site, just to be kind of a simple explanation. I know they have 2 sites, but they have a meter at that substation, which is feeding information to ERCOT around the clock. And, it's got a direct line of communication into ERCOT, which is called SCADA. SCADA is the way that wholesale electricity market gets transmitted. Wholesale electricity market data gets transmitted between ERCOT and all of the people who have a substation in ERCOT. And so the take or pay contract basically looks at the meter at the Riot site and then looks at the power contract that was entered into between Riot and whoever the other side of that trade was. I think it's TXU. And then it nets them out. So if Riot has a very low reading on its substation meter, you never get your substation to zero.
Right.
Because there's always some energy going through the substation itself. And then, in our site, we have pumps and fans and things that we lights. Yeah. You just never turn them off. And so let's say in Riot's full mining curtailment state, if they have 400 megawatts of total load, they're probably dropping down to like 2 or 3 megawatts when they're fully curtailed, maybe a bit more. But so during that instance, the counterparty on the power contract would read the meter and see 4 megawatts of load versus whatever amount was hedged. 400 megawatts is their total load. So there would be 396 megawatts that they would then say, okay, this is part of the take or pay. So you didn't take the power, so you pay the difference between what the sticker price was on the power hedge and where the real-time market settled. So let's say that like in the winter storm last Christmas, some of Riot's immersion infrastructure, I believe, was damaged. And so if they had that power hedged, but that mining equipment was actually offline, then they would be still paying for the power during those intervals, wherever it settled. So if they weren't taking that power and it was settling lower than where their hedge price was, they still have to pay that counterparty. And of course, if prices are settling much higher during those intervals, then Riot is being paid by the power market counterparty. So the $31 million that they made was largely coming from their power market counterparty because Riot had curtailed their mining operations during those periods, and their substation meter would show, very, very little load during those times. And then the real-time market for power was settling very high.
Yeah. So thank you, Jamie. I really appreciate that. There, that whole world, I'm up in Minnesota. we don't really have a whole lot of exposure to that type of, power market. So I appreciate that, because I find that that's really fascinating. I think I saw some news headlines regarding the riot curtailment that were, I don't know if it was misleading, but I think it said the state of Texas paid Riot $31.7 million. It's like, well, I don't think the state of Texas paid them.
Well, and ERCOT paid them
like
$7 million.
Yeah. I think
for
ERCOT
ancillary
was like
services.
7 of it. Yeah.
Right.
Yeah. So,
which is
a little
basically
misleading on the,
it's the same thing. I mean, all market participants in the ERCOT wholesale market pay for ancillary services. So we pay into ancillary services every month. And ancillary services are, Blake King from Galaxy, he describes it, very eloquently, saying it's a short-term capacity market where ERCOT will look at the next day's weather forecast and load forecast, and they will pay a certain amount of money to ensure that the power stays on the next day. So if you look at a capacity market in, say, a fully regulated grid like the New York ISO or the California ISO, they have a capacity market every time, which is just a fully regulated monopoly where the utility is the counterparty in all electricity market participants. They buy all the power and they sell all the power to everybody else. So that in those grids, you have on average much, much higher prices and much less power volatility. The grid buys all of the volatility, and then they subsidize that by charging higher baseline prices to all consumers. In Texas, they only do that when the forecast is really, really high, and they let the free market price volatility by having very, very wide bands of pricing. So in the $5,000 per megawatt hour prints that you see in a month like August, that goes into every single underwriting model for anyone who's trying to build a generation facility in ERCOT, and they're like, oh, holy shit, we can make $5,000 a megawatt hour during that month. That's great. So that is the free market volatility effect, being a big component of the financial modeling for building a generator versus the highly regulated monopolistic one, where in those states you have higher baseline power prices for all consumers, but you have much less volatility.
Yeah. So it's just a little bit of a pivot, but kind of staying on the risk or the volatility part of things. And I'd had a conversation with Dan Roberts at Iris, and he had made a comment about different risk profiles. And one of the ones we talked about was being, behind the meter at a wind farm. I'd love for you to maybe just kind of double click on that, or go, share your thoughts on that. I mean, you guys are at a wind farm and you guys are behind the meter, and would love to hear how you guys kind of think through the risk profile on that. Especially since you guys kind of also have a non, wind farm facility as well. So maybe if you could go there for me.
Right. So just to clarify, our configuration is a little unusual, which is we're technically not behind the meter at a wind farm. We share a transmission line with an active wind farm, but both the wind farm and the mining load are separately metered. And so there is no instance where we can buy energy directly from the wind farm with the current metering configuration and not pay transmission charges and not have that be metered by the, by ERCOT itself. So there are a number of behind the meter configurations in Texas. There's a company called Satoshi Energy. They specialize in behind the meter wind and Bitcoin mining co-locations. And the reason why those arrangements are attractive is it's this similar motivation as why the private equity company that we ended up buying our decommissioned wind farm for the transmission assets. It's the same motivation why they came to us to try and get us to go behind the meter and co-locate there. Bitcoin miners need interconnections, and building a ground up substation is very expensive and it takes a lot of time. A ground up substation is between $10 and $20 million, takes 1 to 2 years, sometimes longer. Most Bitcoin miners are not going to have that capital ready to deploy and that kind of time to wait. Bitcoin mining is a very, very quick game. So what those configurations look like, it's a really interesting electricity market dynamic. The wind farm will say, hey, you Bitcoin miner, I'm going to let you build your data center behind the meter at my wind farm, and you don't have to go and build a substation. We'll save you all that cost, and we can get you interconnected in a year. Sounds great, right? Okay,
Yeah.
Bitcoin miner will say, all right, cool. So what's the catch? And the wind farm will say, well, the catch is that normally if you're going to go and interconnect in the West Zone, you're going to, and you have your own meter and your own substation, like Cormint has its own meter and its own substation. We're actually being paid to consume power about 15% of the year. And the time when we are being paid to consume power is when the wind speeds are the highest across the West Load Zone. And there's too much wind power. The export constraint on the CREZ lines has been reached, and that power can no longer flow to East Texas. So what happens is the price starts dropping below zero to incentivize the generators to shut off, or incentivize anybody who can spin up load to put more load on the grid, because you're actually being paid to take that power off the grid. If you are co-located with a wind farm and you're a Bitcoin miner, what those contracts will look like is the wind farm will have the ability to put that electricity to you, so like a put option.
Sure.
And it will be at a floor price. So say $10 a megawatt hour. The wind farm will say, look, anytime we want, we will be able to sell you our power, and the price will always be $10 a megawatt hour, never lower. So the wind farm basically gets to avoid all of the $0 and negatively priced intervals that they would normally be paying money to generate. By having the Bitcoin mining load, they can just dump all that power into the Bitcoin mining load, and they avoid all of those negatively priced intervals. So basically, Bitcoin miner gets substation, interconnection, and some land, and the wind farm is buying a put option to sell power to the Bitcoin mine whenever they want. It's still very low cost power, but the difference between $10 a megawatt hour and negative $20 a megawatt hour, if it's 15% of the year, it's a material amount of money.
Oh, interesting. Yeah, I think I really appreciate that, because that's a fantastic walk through how that whole relationship could work behind the meter. I know that that's not your guys' situation and strategy, but I really appreciate that, because I think it highlights, like, that's a very mutually beneficial relationship. Yes, I do hear and understand that, while you could capture a lot more benefit by, being on the greater grid system and capturing those negatively priced, that 15%. It's still a great example and highlight of the benefit that Bitcoin mining has for a grid system. Jamie, I want to just keep a tab on the time. I know that we could keep going. We're probably going to have to just set up a whole nother episode in the future. I'd love to hear from you. What does the future look like for you and Cormint, and what are you guys working on that we could expect to see in the near future from you guys?
So Cormint is we have an active capital raise in the market that we are actually allowed to talk about publicly. It's a Bitcoin denominated venture debt note that we issue into the market. We have issued, I think we just announced that we had issued up to 650 in the first wave. So we closed 650 BTC in debt, and we actually just closed another 150 over the last 2 weeks or so. So we're at 800 total BTC debt raised, and the style of the debt is it's a venture debt product. So it's got a 3-year term. It's got a 10% interest only coupon. All of the interest and principal is Bitcoin denominated. So if you have Bitcoin and you lend it to Cormint, you do not incur a tax liability. And when you're repaid your Bitcoin at the maturity of the loan, you don't incur a tax liability on that. You do incur a tax liability on your interest payments, of course, but it's it's a tax neutral way to monetize some of the Bitcoin that you're sitting on, and it also carries with it pretty solid warrant coverage in the business. So all of the note holders receive warrants to buy common stock in Cormint, and most of them have exercised those warrants, and they're also totally secured by the assets of the corporation. So, one of the big challenges in getting people to lend their Bitcoin is nobody wants to lend their Bitcoin. Actually, one of the prospective investors we talked to, he said, this Bitcoin is the only asset in my entire portfolio that has no counterparty risk. I have it in a hardware wallet. It's sitting in my safe, and I have no counterparty risk with this. So the idea that I'm going to lend this to somebody, it defeats its purpose in my portfolio. And I said, you know what, that's a great answer. I can't argue with that. But for a lot of people, they lend a small portion of their Bitcoin, or they don't even own any Bitcoin, and they want to buy some Bitcoin to participate in this product. They are secured by a first lien on all of the assets of the corporation. So that's our substation, our transmission line, all of our mining machines, all of our electricity transformers, dry coolers, intellectual property, everything that is property of the corporation is subject to a lien that the note holders have on the business. So, it's 800 Bitcoin total has been raised, and that is what Cormint is focused on doing. Is we are trying to build a Bitcoin denominated capital markets business that is backed by a very competitive Bitcoin mining business. In the first half of this year, Cormint had the lowest cost per BTC amongst all the reporting public companies in North America. So meaning our electricity cost to produce one Bitcoin was the lowest. It will not be the lowest in the third quarter because we did not have a big power hedge, so we didn't benefit from any of the power volatility that occurred in August. August was a record-breaking volatile power month, so that was extremely painful for the company. But we were number one through the first half, and I think we'll be up there, at least in the top 25% in terms of efficiency for the full year. So that is the way that we believe Bitcoin denominated financial services and Bitcoin denominated yields can be safely generated for Bitcoiners. And that's kind of the niche that we're carving out for ourselves.
Oh, that's fantastic. Yeah. I mean, for me personally, I really love that prospect. Just it's the physical infrastructure of it all that I'm really drawn to when it comes to Bitcoin mining. It's, very utilitarian, very infrastructure driven. So that's very exciting, Jamie. And I want to make sure that, we leave a handoff for the audience. How can they get in touch with you and maybe just Cormint at large? And we can link out to everything in the show notes as well.
So check us out at our website, cormint.com, or LinkedIn, Cormint Inc. That's also our Twitter handle, at Cormint Inc. My Twitter handle is at James McAvity. And I think we've posted quite a few updates on our progress on the website. That's where we tend to update our investor base and the broader market on what we're up to. So, if you follow us on LinkedIn, Twitter, or just check the website, you'll be able to stay up to date on everything that we're doing on there.
That's fantastic. Jamie, this has been a phenomenal conversation. I think, again, I really think we'll have to schedule round two because there's quite a bit that we didn't get into that I was hoping we would. And I really appreciate your time. You take care.
Thanks, Ben. Talk to you soon.